All right, stocks trying to hit 5 straight days of gains. It certainly feels like a while since we've seen that. 30 minutes until the start of trading. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, it's 50 versus 25. Economists split on how the Fed will communicate next week's policy action. And no deal. Boeing shares are sinking as factory workers walk off the job for the first time in 16 years. And sticker shock. We'll speak to the CEO of SpartanNash as consumers across the nation grapple with increasing grocery bills. 30 minutes to go. Let's take a look at where markets are trading right now. And like I said, a little bit of green on the screen. Of course, that would be 4 straight days of gains, 5 straight days of gains for the S&P 500, which we will show behind me at some point. Of course, we saw 4 straight days of losses to start September. We'll see, of course, if we can keep the momentum going on the S&P 500, currently up about 0.2%. The NASDAQ 100 can't really decide what to do. Your big tech stocks currently unchanged pre-market. And then you take a look at the 10-year yield, Sonali, currently lower by about a basis point.
We'll talk a lot more about that bond market. I know it matters today going into that Fed meeting this week. But of course, some stocks to watch pre-market. Talking more about Boeing because it's down as Seattle employees walk out on strike for the first time since the great financial crisis. You have Boeing shares down almost 3% pre-market. We'll talk more about that. On the earnings front, Oracle impressed Wall Street with a bullish 2029 revenue target, while Adobe disappointed with guidance on AI investment returns. You have Adobe just sinking now more than 8.3% pre-market, and Oracle up more than 6.3%, Katie.
A good reminder, of course, that we are still in earnings season, but let's go back to the bond market and why it matters today, because, of course, bets on a 50 basis point cut next week are building again. You have Bill Dudley, of course, coming out, making the case for 50. You also have Neil Dutta over at Renaissance Macro pounding the table in a note this morning. And let's just be honest here, the elephant in the room, Nick Timrose over at the Wall Street Journal, out with an article, of course, exploring the case for a 50 basis point cut, which really reignited this current round of speculation.
He's defined himself as really the Fed whisperer this cycle, which is why traders are taking this report so seriously. And the question he poses at the very top is start small or begin big. And really, you're looking at a market on the razor's edge, Katie.
It is really interesting. Of course, Bill Dudley kind of exploring that as well, saying that right now, the risks to the labor market, those are more pressing than any concerns about lingering inflation here. So it's up to the Fed. I mean, less than a week to go. It's a big decision, and it's a live meeting.
And it sets a tone for the rest of the year. We're going to discuss this now with Hazen, F.L.Putnam, Chief Market Strategist. And what would 50 basis points say to the market? There's a worry under the surface that 50 might be a little drastic here and set off this idea that things are worse than they seem. There's a flip side here that says if you start big, then it creates room to go less later on. How do you feel, Ellen?
That's the question of the day, Sonali, isn't it? And that's what everyone's talking about yesterday and today, especially after the Wall Street Journal piece that you referenced, as well as some other comments made by Mr. Dudley and others. So as we look at it, we think that a 50 basis point cut would be more problematic than a 25 basis point cut. And the reason for that is that, first of all, a 50 basis point cut does say, look, things are more serious than maybe you might know. And it does indicate a little bit more strong action, which might spook the market. But the other side, which I think is just as important, if not more so, is that a 50 basis point cut is very likely to boomerang on the Fed and to cause the equity markets to spike, thereby loosening financial conditions a lot more and maybe taking a little bit of that control out of the Fed's hands, which I don't think they want to do. So we think, like the market most of the time, that 25 basis points now, another 25 perhaps in November and December is the right move. And we think that 50 basis points not only sends a message that things might be worse than they seem, but also might complicate their job by sending the equity markets off to the moon again.
Oh, very fairly, Michael McKee points out that the Financial Times also has been pointing out the question about the razor's edge we're standing on as well. A little shout out to our former producer, Colby Smith over there. Ellen, you know, if you think about the spillover effect there is to the equity market from the bond market. Is there a significant one that you expect, whether they go 25 or 50?
I think that the equity market is very focused on corporate earnings growth and what growth is going to be next year from a GDP perspective, what jobs are going to be, and what corporate earnings are going to be. And right now, that looks pretty healthy at 15%. I don't think that the equity market impact is going to end up spilling over to the bond market, which is much more focused on inflation and overall economic growth, but not so much corporate growth. So I think that those might be not as closely joined at the hip as they have been in recent months.
And Ellen, give us the outlook for small caps here. I mean, this has really been the back and forth, hot and cold trade of the past several months. I mean, if we enter into a cutting cycle where maybe the Fed is a little bit more aggressive than markets are pricing in right now, of course, taking that more cautious tone just to front load a little bit here, what would that mean for that universe?
It's been a really tough slog for anyone who's tried to invest in small caps over the last couple of years because there have been at least 4 pretty big false starts where in any given month, small cap universe has outperformed and then gone on to pretty dramatically underperform over the subsequent months. And the reason for that, as we see it, is that small cap earnings just are not there, right? So we all know about the debt and the fact that small cap companies have higher debt, more variable rate debt, they're more adversely affected. But the really important thing is that estimates for the small cap indexes just keep going down in a way that S&P 500 estimates are not going down. So you saw this false start again in July, right? And then where small caps outperformed, people thought, okay, now is the time. And then in August and in September to date, it's just been another disappointment. We don't think small caps durably outperform until after the economy has slowed and is exiting either a recession or a dramatic slowdown. We think in a soft landing scenario, when you have economic growth okay, that small caps are not going to do better than large caps. They just haven't gotten quite cheap enough, and you don't see that reacceleration that you really need in order for small caps to outperform.
All right, Ellen Hazen there, of course, with a dose of reality for the small cap trade there. Let's get specific here. Let's name some names and talk about some of your individual stocks. I see Booking Holdings on your list, for example, which I find interesting because so much of our conversations are centered around that slowing consumer, of course, that cost-conscious consumer, and yet here we are.
So we like Booking for a couple reasons. Number one, it's a pretty reasonable valuation for the growth that you're getting. And number two, regardless of the shorter term consumer slowdown, which I agree is happening, it's clear from the data that that's happening, you have this long-term secular trend toward experiences from goods and toward online from using travel agents. And so I think that Booking taps into both of those very well. You see estimates continuing to go up, and the company is very well positioned. I think that longer term, this is a winner. Shorter term, could you have softness because of a softening consumer? Yes, you could, but only if you're trying to trade day to day, week to week. I don't think that that's going to be a longer term problem.
Ellen, I also want to talk about D.R. Horton because this is another play that is very firmly tied to the interest rate outlook here. And is 50 basis points, even if they get there next week, is that enough to set off the housing market significantly when you have such an overwhelming amount of mortgages really held still below 4%?
I think that the impetus and the catalyst for D.R. Horton is not necessarily a rate cut because, as you correctly point out, Sonali, the rate is not going to make that much difference on a 10 or 30-year fixed mortgage rate going forward if we cut by 25 or even 50 basis points. But there's a structural shortage of housing in this country, so there's this very long-term demand tailwind. In addition to that, D.R. Horton is focused on the growth areas of the country geographically in the Sun Belt region, which is where population keeps slowing. Every quarter we look at the numbers and population keeps flowing to those areas. So they have a secular demand driver from that front as well. And then finally, from a valuation perspective, you're paying a low double-digit multiple for earnings that are growing pretty strongly. So they're not levered the way many of the home builders were before the great financial crisis. They're at 2.2 or 0.3 times debt to EBITDA, so very safe balance sheet, pretty strong growth, and very reasonable valuation for what you're getting with these secular tailwinds. I don't think you should buy it with the idea that a 50 basis point cut is necessary in order for the stock to do well.
And Ellen, before we let you go, of course, you take a look at the bond market right now. Usually we don't talk about it with 20 minutes to go until the market open here, but traders currently pricing in a 40% chance of a 50 basis point rate cut next week. I want to bring that in with your positioning because right now, according to your notes, you're underweight fixed income, which stuck out to me. Of course, we are on the precipice of a Fed rate cutting cycle. How unusual is it for you to be basically underweight bonds right now at the start of such a cycle?
That's a great question. The reason we're underweight bonds is because of what else you can invest in. So if you're underweight bonds, it means you're overweight something else. And we're overweight cash and overweight equities, and we're overweight some alternatives. And despite the fact that we might be at the beginning of a rate cutting cycle, I mean, I think we are at the beginning of a rate cutting cycle, that still doesn't make bonds attractive enough to be overweight compared to what you can see in equities, compared to how much you can still make in cash, and compared to some of the opportunities available in alternatives, and particularly in some of those increasingly democratized alternative private investments that investors can access in a way that they didn't be able to used to access 5 years ago.
All right, Ellen, really great to speak with you on this Friday morning. Our thanks to F.L.Putnam, Chief Market Strategist, Ellen Hazen. Meanwhile, let's get a check on futures right now because, again, trying to make it 5. We've seen 4 straight days of gains for the S&P 500 so far this week, following 4 straight days of losses last week. Right now, the odds are in your favor. The S&P 500 currently up about 0.2% pre-market. Of course, a lot can change between now and 4 p.m. Meanwhile, you see the NASDAQ 100 currently flat on the day. Not that enthusiasm in big tech. Of course, we've seen little hints of it over the past 4 days, not so much right now. Let's get to some specific stocks, though, because we do have some breaking news, and that is that Waymo is going to offer Austin and Atlanta rides only on Uber next year. That has been a boon for Uber shares right now. You can see currently up about 5.6% pre-market. We're going to continue to follow that story and others. And to that point, let's get a look at the stocks moving ahead of the opening bell right now. We'll do that with Abigail Doolittle.
Well, Katie, it's super interesting because we do have the shares of RH surging. They're up about 20%. This, of course, is the company formerly known as Restoration Hardware, that high-end furnishing retailer. Again, up 20% on a very good quarter. They beat estimates. Sales rose 3.6%. They also provided a positive update on the future. They're saying that the healthy demand that started in the first quarter, that just showed up in the second quarter, it's likely to extend. Now, it is worth noting that there's a roughly 13% bearish short interest, so some of this could be a squeeze. But Citi is saying it's a solid step of progress. Turning to a stock that's down but well off its pre-market lows, Flutter, right now down about 0.5%. Flutter Entertainment. This, of course, is the mobile and online gambling services company. They've announced a 56% stake in Brazil's NSX. That's worth $350 million. Initially, it's expected to weigh on earnings despite bringing in more users. This may be why investors are a little bit pessimistic. And then finally, Moderna down for another day. Yesterday, falling 12% after they cut their R&D budget. They also are trimming their pipeline, having a rough time after less demand for that COVID-19 vaccine. This stock down more than 80% from its pandemic peak. Well, today, there's a slew of downgrades. Some analysts apparently think that maybe there's further downside. Oppenheimer, JP Morgan, Jefferies, Leerink, and there's more, down 5.6% in the pre-market.
Abigail, we thank you so very much for keeping an eye on all of it for us. Now, coming up, we're going to switch and talk about Boeing because factory workers go on strike for the first time since 2008. We're going to discuss the implications for the economy and the travel industry. This is Bloomberg. And now to high interest, a look at what's making headlines around the world. China will raise the retirement age for the first time since 1978. The move could stem a decline in the labor force, but it risks angering workers who are already wrestling with a slowing economy. Under the rules, men will retire 3 years later at 63, while women retire 5 years later at 55. Hindenburg Research is taking another swing at the Adani Group. The short sellers said in a post on X that Swiss authorities had frozen more than $310 million as part of a years-long probe into the Indian conglomerate for money laundering. The Adani Group denied what it called baseless allegations. And Roaring Kitty is meowing again. A post about Petco on the subreddit dedicated to the retail trading icon Keith Gill has helped boost the company, which has posted encouraging results earlier this week. Gill didn't actually mention the stock on his own Reddit, YouTube, or X pages, and there's no evidence that he owns a stake in the company, Katie.
All right, meme stocks, they never die. But let's switch gears here. Let's talk about Boeing, because you take a look at shares right now. The struggling plane maker now dealing with a walkout in its Seattle hub, where a union representing 33,000 workers overwhelmingly rejected a contract offer. Let's discuss now with Sid Phillip. He is Bloomberg's deputy editor for global aviation, usually based in London, joining us on set. It's great to see you.
Yeah, likewise. Thank you for having me here.
It's good that you're here because, boy, it just feels like the hits keep on coming for Boeing. We'll get into the TikTok of what exactly happened with this deal, how it fell apart, but just put this into context for how bad this is for Boeing at a very critical juncture.
It's a crucial juncture for Boeing because, I mean, at the moment they've had to curtail production of their 737 MAX jet, which is the sort of workhorse jet for them. Essentially, they haven't been able to make enough planes. They've been sort of, the FAA said that they are sort of restricted to making 38 after the whole mid-air blowout that they had in January. And so Boeing's been sort of in sort of the ringer at the moment. They've had a management change with a new CEO. They've had a new chairman. They've had sort of management reshuffle. And essentially for Boeing, they really need to get planes back out of the door because at the moment, there's no way for them to actually sort of start generating cash, which is vital. I mean, they have a 45 billion pile of debt that they need to get through.
So talk about this week alone, because the new CEO, Kelly Ortberg, seemed to have some wins in his discussion with labor. You fast forward just a couple of days, and a lot of those wins seem to have been reversed. Is this an about turn? How difficult does this make his job?
It does make his job really difficult because for Boeing, they really need, like Ortberg's entire priority is to get their production back on track and get sort of planes out of the door so that they can sort of start generating cash and start working on their debt pile. And this is a setback towards that goal. And for the workers, I mean, the union did agree to a deal where the workers would have got 25% over 4 years, but the workers were expecting more, and essentially they've been asking for increased pensions, return to pensions, they've asked for increased healthcare, and they've asked for better pay. They've asked for 40%. So there is a sort of urgency to it, and the union and Boeing have said that they are working towards a deal, but it remains to be seen.
Yeah, 25%, certainly not nothing, but it's certainly not 40%. Still, it's striking just how overwhelmingly this was rejected. You take a look, union workers voted 96% to support a strike. I mean, talk to us about how much distance is between these two sides. What is it going to take to bring them back together, essentially?
It's going to take a deal that the workers are so on board with, and I think the workers are pretty angry at the moment in terms of what they've actually been given, and they're looking at how they can actually get what they've asked for. And the workers are in a really strong position at the moment because Boeing, because of all its various issues with production, is desperate to get a deal so that they can actually get this in. So for them, it's a really good position to be in.
Talk through the potential economic implications for Boeing here, because if the workers are on strike, obviously they're not sitting making planes and other things that Boeing needs them to do as well. Do we have a sense of how long they may strike for and what it could mean for Boeing ultimately?
So the analysts have said it could essentially, if it's 50 days, which was what happened in 2008 and previously, that would cost about 3 to 3.5 billion in terms of the impact on Boeing's cash flow. So it is a significant impact, and essentially every day that Boeing's not building the 737 and the 777 and the 767 freighter, it is a sort of that many days for that they can't actually produce planes and actually deliver those planes, which is when they actually get paid. And so for Boeing, they need to get those planes out of the door and actually start generating cash again.
Yeah, and I mean, to that point, they need to start generating cash again. How much can they actually afford when it comes to the price tag it's going to take to sort of reset labor relations onto the good path here?
I mean, that's the billion-dollar question. Essentially, what is Boeing willing to pay in order to make this problem go away and essentially get their production back on track?
ultimately, when you think about the predicament they're in now, you were talking about this idea of them needing to get those planes out the door to get paid. What do their partners do in this scenario? Are more and more of them looking for other options?
In terms of, if you're talking about customers, I mean, customers have no options because the global industry is basically a duopoly, and Airbus is sold out of its best-selling A320 jet until the end of the decade. And so there's no option for a customer to actually do anything but actually just wait for their plane. And so they haven't actually got a solution.
Do consumers then feel that problem at the end of the day?
They will, because essentially they'll be flying around in older aircraft. There'll be older aircraft that are in service for much longer. And some airlines may not have as much capacity on offer as they would have had those planes been produced.
It's just a wild state of play, of course. That duopoly you describe, it's either Boeing or it's Airbus, and increasingly that just means you're flying on older planes. Sid, great to see you in person. That, of course, is Bloomberg's Sid Phillip. Now, coming up, Uber's autonomous vehicle foothold just got a lot stronger. Details next in our Social Climbers. This is Bloomberg. All right, we are moments away from trading, 23 seconds to be exact, on this Friday, the 13th. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. You can see we have some green when it comes to futures right now. Of course, as traders really debate what would be good news from the Fed last week. Of course, would a 50 basis point cut signal that they're worried about something, or would it signal that they're serious about supporting this economy? A lot of big questions hanging over the markets, of course, as we round out what has been a very good week following a brutal start to September. You can see the bells currently ringing right now at both the NASDAQ and the NASDAQ. The New York Stock Exchange, that is. Let's take a check on the major averages right now, about 17 seconds into trading, and it's pretty much as expected. You can see the S&P 500 currently up about 0.2% right now. The NASDAQ 100 can't really decide where to go. Big tech has been bouncing back and forth between gains and losses in the pre-market, currently a touch lower. But we have one clear winner, and that is your small caps. The Russell 2000 currently up to the tune of about 1.1%. We'll see how that one develops. But let's take a look under the hood right now, because we need to talk about Boeing. Under pressure after a union representing 33,000 employees rejected a contract, forcing the first strike since 2008. And Sonali, you take a look at the reaction in shares right now, currently down about 1.4%.
Red on the screen is never good, but at least it's less than it was before, right, Katie? Well, let's look at a stock that is just absolutely soaring. Restoration Hardware, soaring on demand for luxury home products here, improving 18% higher as the market opens. This is despite cutting its sales forecast for the year. And some earnings movers. Oracle moving higher after reporting a promising long-term outlook. Wall Street was impressed by a bullish 2029 revenue target here, and you have the stock up more than 7.2% at the open. But on the other hand, Adobe down 9%. Sales guidance fell short of Wall Street estimates, raising concerns about whether its bets on AI are paying off. We're going to take a closer look now with Bloomberg's Abigail Doolittle.
And let's put those moves, Sonali, into the context of the week, because, of course, Katie just mentioning that we're looking at a good week for stocks after a bad week last week, that rough start to September. And on today's fall, coming into today, Adobe had been set for a 4% gain, now down about 5% on that weaker than expected forecast, as you just mentioned, Sonali, having to do with less ability to monetize their AI tools. Oracle, on the other hand, now in the week, a banner week, up 22%, its best week going back to 2021. They, of course, had this investor update where they did raise their sales forecast essentially for 2026 to $66 billion. They also said that this trajectory should continue to 2029. That comes just after that strong report recently where they also announced another deal with AWS. So Oracle, one of the top software stocks on the year, up more than 50%. Let's dig into that Adobe pain, though, just a little bit more. These are the sequential growth numbers, or I should mention the year-over-year revenue numbers for Adobe. And you can see that we peaked back in fourth quarter, and now we've been moving sort of to the downside. This third quarter, an estimate here just slightly sequentially higher, but not overall, not a lot of great growth here. And when this is interesting to me for certain, Katie, if we take a look at this chart of the S&P 500, an ETF relative to the AI ETF, I would have thought, based on NVIDIA and Supermicrocomputer and some of these other AI chip companies, that the AI ETF would have blown the SPY out of the water, but that's not the case. The SPY up about 17%, the AI ETF right below. So maybe some of that Adobe weakness is factoring into this ETF.
Yeah, it's fascinating, too, to see when those lines broke apart. Of course, it seems like it was right around when we were sorting through all those big tech earnings. So clearly a sign of the times there. Abigail Doolittle, thank you so much. Let's broaden out this conversation now with Brooke May. She is managing partner of Evans May Wealth. She has an S&P 500 year-end price target of 5,600 to 5,800. And Brooke, we're right about at the lower end of that range. I want to talk about the Fed next week, though, and of course how that factors in, because I'll ask you the question that I've been asking everyone, and that's whether or not 50 basis points, whether that a cut of that magnitude next week, would that be good news at this juncture? What does sentiment look like?
I do think it would be good news. That said, I was surprised to hear Dudley come out and say that he felt a 50 basis point cut would be warranted. When we look at the totality of the data, it doesn't necessarily feel like we're in a dire situation where we need to expedite rate cuts. When you look at historically rate cutting cycles, the playbook isn't relevant. Typically we're cutting because we need to stimulate the economy or there's an energy crisis or there's a bubble that's burst. And so they have the ability to be cautious. They've been cautious all along. And Jerome Powell hasn't done anything to indicate that they're going to change their posture. So a 50 basis point cut would be welcome. However, it would surprise me.
Well, let's talk about why it would be welcome. I mean, is that because you think about sort of the effect of these higher interest rates, the fact that we're clearly in restrictive territory, or would it be good news basically because it signals that this is going to be a more aggressive Fed, that they're going to mightily bring down interest rates, which will ultimately maybe lead to that broadening out that we've been talking about beyond big tech?
I think that it's that, we're just ready. We're ready to get back to neutral. And it doesn't need to be aggressive, but we need to show that we need to demonstrate that we're moving in that direction because it is restrictive. When you look at small cap companies, for example, today they're rallying and, they've been under pressure. They've been under a significant amount of pressure. When you look at small cap in general, only about 60% of those companies are profitable and they rely heavily on debt. And not all small cap companies are able to lock in fixed rate debt. So they're subject to variable rate debt, which is very expensive. And clearly that cuts into their profits. So as we see rates come down, that's going to bleed through to small cap earnings. Now, it might take a few quarters to actually see the impact. But in anticipation of that, we're going to see small cap rally. So there are going to be clear beneficiaries across the board of the economy with lower rates.
I guess how much does the Fed really have to cut to see that benefit seep through, especially kind of those more heavily levered companies? We say small caps, but it's not limited to small caps, is it? And it's 50 basis points if we get there next week, even enough.
Mm-hmm. Yeah, the Fed has a dual mandate, price stability and maximum employment. And we have seen unemployment tick up. However, this last reading, it actually ticked down. We went from 4.3% to 4.2% unemployment. So it's not a rapidly deteriorating labor market. When we look back, we had 2 years of sub 3.9% unemployment, which is just incredible. From February of 22 to January of 24, every read was under 3.9%. So now that we're at 4.2%, we're clearly moving in the wrong direction, but it's not unraveling quickly. What's held up the economy the last few years is the labor market, and we don't see that changing. When you look at the CEO surveys that have come out recently, CEOs are indicating that they expect hiring to be stable over the next year, that they see wage growth in excess of 3% over the next year. And a year ago, CEOs were predicting an 84% probability of a recession in the next 12 months. Now that number's 30%. All that indicates that the labor market should be sustainable, assuming the Fed starts on this path to neutral.
It's interesting.
So I don't think it needs to be aggressive.
It's interesting to hear you talk about CEO confidence there, Brooke, because I wanted to shift us over to consumer confidence at the top of the hour. In just over 20 minutes time, we get University of Michigan sentiment data, which has been increasingly important to those viewing the market and the consumer sector in particular. What role does the consumer play, and how much of a boost they get into this rate cutting cycle?
The consumer's huge. The consumer plays a significant role in this economy, and it boils down to, though, if consumers have jobs, they spend, and that's what keeps the economy afloat. Right now, we're seeing wage growth in excess of inflation. And so the sentiment out there is decent. It's not as robust as it's been in previous readings, but we don't see it completely deteriorating because people are working. There are headlines of inflation, or headlines of layoffs. However, there's not broad layoffs across the economy. It's small pockets here and there that are catching headlines, but not necessarily detrimental.
And Brooke, quickly, before we let you go, I want to get back to the horse race of these year-end price targets, because the top end of 5,800 places you among the biggest bulls on the sell side right now. We're at the lower end right now on the S&P 500, about 5,600. How confident are you that maybe the S&P 500 can add those additional 200 points by year-end?
Well, we're setting the expectation with our clients for the next 2 months. Fully expect volatility. September, October tend to be poor performing months in the market. On average, over the last 25 years, September, the market's been down about 1.7% on average. So we're setting the expectation near term, there's going to be volatility, but we're going to use that volatility as buying opportunities, because when you look at the earnings growth projections going into 2025, they're good. We think big tech earnings growth will be around 18%, and we think the broad market will have earnings growth around 13%. That's more robust than what we saw going into this year. So we think that it's going to be earnings that take us higher, but it might take us 45, 60 days to start to move in that trajectory to get closer to that 5,800 price target.
Brooke, happy Friday to you. That is Brooke May, Evans May, Wealth Managing Partner. We thank you for your time. Now, I want to bring you some breaking news, because the Los Angeles Chargers and the Miami Dolphins are among NFL teams mulling private equity deals. Remember, the NFL opened up to the idea of private equity investment, with team owners voting just about a couple weeks ago, really last month. They still need final approvals, but Bloomberg is now reporting that the Chargers is in advanced talks with 2 buyout firms already to offload a stake. And of course, the Dolphins also in talks with those private equity firms alongside potential individual buyers. These are 2 major markets. And of course, the deal making is on. Now, coming up, sticker shock in the grocery aisles. We're going to explore that with Tony Sarsam, the CEO of SpartanNash, a national food distribution and grocery retail chain. We'll get under the hood of what pricing looks like across the food aisle. This is Bloomberg. Grocery prices aren't climbing as much as they had been in the last 2 years. And in fact, online grocery prices fell 3.7% last month, according to Adobe, the largest decline since the firm began tracking the numbers 10 years ago. Still, of course, many Americans are still frustrated by what it costs to put food on the table. Joining us now to talk about price of food is Tony Sarsam. He is the CEO of SpartanNash, a food distributor and grocery retailer. Let's talk about the good, the bad, and the ugly here. Of course, inflation, particularly at the grocery store, is a hot button issue for Americans all over the country. Where are you things seeing meaningfully get better?
Great. Well, thank you again, and thanks for having me back. I appreciate being here. Let me get a little backdrop on SpartanNash before we get started to set the table a little bit. We are a food solutions company. We are in the wholesale business and the retail business. So we provide groceries and consulting services to about 2,300 grocery stores, including the ones that we operate ourselves. We are a proud provider of groceries to the U.S. military system worldwide, and so that gives our men and women in uniform a little taste of home wherever they may be stationed. And we have 17,000 associates that help us deliver the ingredients for a better life every single day. So that perspective of both the wholesale side and the retail side gives us some great insights as we see what's coming up and what's going on in the near future. So Hot topic, obviously, around pricing. One of the interesting things is there's an idea that food prices have driven a lot of the inflation in the last couple of years, and it's not really supported very well by the actual facts. You guys saw the CPI data here recently. Inflation is moderated down to 2.5%, and food prices are down to 0.9%, and they've actually trailed overall inflation for most of the last 2 years. But people are still very concerned. They're very concerned about trying to make the ends meet overall, and they focus on grocery bills. As a matter of fact, about 79% of the folks that we've talked to in our own internal survey say that pricing of groceries is the most important thing for them. And we take that very seriously. And so we think about how we construct the overall offering to our shoppers. We want to make sure they have access to value and actually the other things that they want that they're most important to them.
Well, appreciate that context. And it's a good point. You think about the most recent CPI reading. It was shelter costs that drove a lot of that inflation. So there's a new, of course, boogeyman out there. But I want to talk about categories, because you look at overall food costs and they barely rose last month. But then you take a look at an index for meats, poultry, fish, eggs. It rose 0.8% in August. So how much dispersion are you seeing when it comes to different categories of food?
There is dispersion always, and the ones you just mentioned are interesting because they're close to agriculture commodities, and so you see these effects of things like macro effects, like weather, like a bird flu, which is actually causing the egg prices to go up right now. You see things like the overall tough weather that was in West Africa driving up cocoa prices pretty dramatically. So staples in my cabinet pantry at home, like Nutella and Cocoa Puffs and those kinds of things, those are all experiencing some cost increases because of those effects. But those items like the meat and eggs and cocoa, those prices will go up and they'll come down when the event that caused them stabilize and more episodic. And there are some other more longer-term effects in the grocery categories as well, grocery aisle as well. Those long-term, when you think about overall, Americans spend about 11% of their income on food. It's about the same numbers it was 10 years ago, but prices have gone up over that time frame, and there's some lurking price increases that are sort of interesting and think about how these things get caused. Things like in the last few years, we're paying about 50% more for tractors and trailers, the big rig trucks that get the products from the fields or from our DCs into our stores. The freezer cases in our storage are about 35%.
You know, it's interesting to see where there's still that lingering inflation. I want to pull up a chart here just of cocoa prices, for example, because to the point that you're making, they go up, they go down, and they have come down from their peak, but they are still meaningfully higher than where we were a year ago. It's hard to see how, you know, cocoa's, people like chocolate. Cocoa's a staple, right? Is that fair to say? When you see prices at this kind of elevated level here, what is that ripple effect? Who has this crowded out?
Yeah, so the cocoa being a staple is absolutely the right thing to say. It's a critically important item in everyone's diet. So that agriculture community, particularly the one where most of it comes from West Africa, is not fully recovered yet. So that's where you see the continued higher prices there, as they are kind of recovering from a lot of issues driven by the early weather events, but some other events around farming there. So I think it's going to be a while before we get all the way out of that one.
Right, and it's a good reminder, like you said, I mean, there's so many factors you can't control when it comes to bird flu, extreme weather, et cetera. But we're talking about food prices, and food prices, of course, have become a political issue as well. You think about the conversation happening right now around price gouging at the grocery store. Have you seen any evidence of that? I
have seen no evidence of that. And as a matter of fact, you think about this industry broadly, we are about a 1.6% profit collectively. So that's the most recent data about the overall profitability in our industry. So it's very, very competitive, very low margins. And so we are always, all of us and our competitors are fighting to get shoppers dollars and offer them something that makes our stores attractive to come in and spend their hard-earned dollars. I mentioned a moment ago that 79% of them are looking for good deals. So that doesn't really match up so much with taking extraordinary prices, because you're going to be less competitive in that space. So I think that element is actually a self-governing element. This is such a competitive industry that you're going to always have people fighting for the shoppers' scarce dollars, and so it kind of regulates that overall pricing effects. But there are people who feel those effects that I mentioned a moment ago. There are prices that are passed on to customers because things like the tractors and the freezer cases and even the bags that are up 30% over the last couple of years. And there's one lurking variable I think that's sort of interesting, and that's swipe fees for credit cards. So that's also part of the overall cost, but it's late in the value chain, obviously. It was right at the end. And those fees for us, we've seen a 34% increase in the overall cost in our stores. And while the fee maybe seems small, it's between 2 and 4% typically, those industries are not quite as competitive as there's two companies that control 80% share. There's 21,000 independent grocers who compete with each other for that 1.6%. The two credit card companies have a little over 50% margin. So the interesting stat here is that if you bought $60 of groceries in the store, the store would get about $1 of profit, and the swipe on that would get $1 of profit for the credit company as well. So we're looking at ways we can better regulate that. There's some legislation right now in Congress that may address that. That's a way the government can actually help out.
Tony, we have to leave it there. Hope to have you back soon. It's great to see you in person.
Wonderful to be here.
That, of course, is Tony Sarsam. He is the CEO of SpartanNash. Now, coming up, meet the dirtbag of the internet, who happens to be behind the crypto project promoted by Donald Trump. That's next in our Wall Street Beat. This is Bloomberg.
And it's time now for the Wall Street Beat. In the last year, Donald Trump has fashioned himself into a friend of the crypto crowd. He and his two older sons have been particularly good friends to World Liberty Financial, a crypto project that they've been promoting on social media. To tell us more behind the man behind that project is Bloomberg's Zeke Fox. And it's fascinating because this is somebody, Zeke, that wasn't very well known to the rest of the crypto industry, was he?
Yeah, I mean, his name's Chase Hero, and he was a weed dealer. He sold weight loss colon cleanses, $149 a month get rich quick class. And now he's the guy behind World Liberty Financial, which is a new crypto venture that the Trumps are promoting like just ahead of the election.
Yeah, it's wild. I mean, former President Donald Trump himself has teased in a video that he'd announced details on September 16th. It's September 13th right now, Friday the 13th. What are we expecting to hear? I mean, how intense is this involvement?
Yeah, so I'm told that Hero is the kind of main deal maker behind this. He met the Trumps through a real estate developer who's a longtime friend of Trump. And you said dirtbag of the internet. That's what this guy called himself on a video. I can't even read you most of the other quotes, but he's got like a very cynical attitude towards crypto, and nobody in the crypto industry that I talked to has heard of him. There's a lot of skepticism about this World Liberty Project, even among crypto people who maybe aren't known for having the highest standards for how well thought out projects need to be.
You can certainly go to the story and read it. It is one of the most read ones on the Bloomberg terminal on Bloomberg.com. Some of those expletives are certainly in there. Zeke, why is this the project that Trump is touting when so few people in the crypto industry are really familiar with it?
I mean, that's the question that a lot of people in crypto are asking. Trump used to criticize crypto. He called Bitcoin a scam. Then he went and spoke at the Bitcoin conference. He said he's going to make the U.S. the crypto capital of the world if he wins. But a lot of people in crypto are like, we like that, but why are you now starting your own for-profit crypto venture?
Right.
Like, why not? What does it have to do with crypto policy?
Yeah, a lot of big questions there, of course. It'll be interesting to see, of course, what Donald Trump unveils on September 16th. That is Bloomberg's Zeke Fox. Great reporting, as always. Of course, Zeke is author of the great book, Number Go Up. It's all about crypto. I suggest you go read it. Coming up in our next hour, though, we'll speak to Jay Hatfield and Jason Furman on the economy and next week's Fed meeting. Plus, we'll speak to the CEO of Pirelli about the tire manufacturer's new partnership with Bosch. All that and more coming up. This is Bloomberg. Into the U.S. trading day. Welcome to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today.
Meanwhile, we take a look at markets, of course, as we're awaiting that University of Michigan consumer sentiment data report. You take a look, and we have a rally on our hands. The S&P 500 currently up about 0.4%. The NASDAQ 100 up 0.3%. You take a look at the numbers coming out right now. Michigan preliminary September consumer sentiment rising to 69. That is a beat there. The estimate had been for 68.5. Of course, you take a look at one-year inflation expectations as well, falling to 2.7%. That is the lowest since December 2020. So certainly some good news there. Let's get more context now with Mike McKee. He is Bloomberg's chief international economics and policy correspondent. What's your first take?
Well, it doesn't move the needle really for the Fed, but it does give them permission if they want to go 50 to be more dovish in the sense that it doesn't look like inflation's a problem. At least inflation expectations are a problem in the short run, 2.7%. They go up in the 5 to 10 year, they go up to 3.1 from 3.0, but that's way out there at this point, and the Fed isn't going to think that is any kind of realistic change that they have to worry about. Current conditions rise to 62.9 from 61.3, which is a fairly good increase, and expectations up to 73 from 72.1. So this is probably the best Michigan numbers we've seen in a little bit of time. It's too early probably to know whether the debate had any impact on that because it was just before the end of the survey. We'd only had a couple days to pick that up. But people do seem a bit happier about the overall economy, which gives the Fed the idea also that maybe they don't need to move because the economy's in good shape.
2-year yields are lower on the back of this report as well. And I still am a little bit confused here because if the consumer believes that inflation is going to be around 2.7%, they're feeling pretty good, in fact, better than expected, why cut 50 basis points?
Well, that's the question. The Fed has to decide that they think the economy is in worse shape and needs a quick jolt to do anything, to maintain. The problem is at this point, it's not going to matter a whole lot because it takes a while to get into the economy, so it's not going to have an effect on the election or the way people think in the short run about the economy. So the Fed has to look out and try to figure out what's the economy going to be like in the early part of next year when this might start getting into the overall economy. And that's kind of the question. And as you know, there are a lot of different views on Wall Street about that.
They feel good today. They might not feel as good tomorrow. Michael McKee, we thank you so very much for your reading. And in a few minutes, remember, Mike will have a question and answer session with Joanne Shu, University of Michigan Surveys Consumer Director. You can follow that conversation on Live Go on your Bloomberg terminals. Now let's get more market insight now with Jay Hatfield, the founder and CEO of Infrastructure Capital Management. A lot to talk to you about, Jay, about the market itself and where people are headed in terms of maybe some of these more defensive trades. But let's get back to kind of the key issue of the day, 25 or 50. Do you think that the Fed needs to go 50?
We don't think they need to. We might have about a month ago. The key indicator of a recession is the housing sector. It's hyper-cyclical. Investors spend way too much time worrying about consumers. Consumers have never facilitated a recession. Only investment does. And so 11 out of 12, you had a crash in the housing sector. We are getting nervous about the housing sector, but really the market cut rates for the Fed. The key financial indicator, there's not 100. It's really just 10-year and mortgage rates. So when mortgage rates went below 7, all of the home builders said that traffic picked up. And you saw, even in the last report, 750,000 new homes. So normally that would, if you have a limited home building, you have layoffs, then the consumer goes down. So we're confident the Fed doesn't need to, plus they're very cautious, and they're also concerned about their forecasting ability. So they're likely to do a dovish cut, and that's fine because then the 10-year will stay down.
That's really interesting, the perspective that, okay, actually the market has helped the Fed out here. Of course, the market has been fighting the Fed for so long, it feels like, but now kind of working in tandem here. But just to push back on that a little bit, you think about the case for 50, which has been advanced by none other than Bill Dudley this morning, of course, speaking in Singapore, saying that right now the risks to the labor market are greater than the risks that there are to a reignition of inflation here. It sounds like you don't put much water in that argument.
Well, I agree with that argument, but you have to assess this Fed. Greenspan doesn't run this Fed anymore. So Greenspan just made things up. He would cut rates, after, if the futures were weak over the weekend, he would cut rates. So this is a very bureaucratic Fed. Powell is not an economist, so he just gathers consensus. So I'm sure there will be people arguing for a 50 basis point cut. Now, having said that, we're short the Fed funds futures and losing money. So obviously some people today, not a lot of money because it's a small bet, but a lot of people are responding to some of the journal stories. But they do leak it through the journal, unfortunately. They should leak it through Bloomberg. But,
we agree.
Yeah, but so when they write a story on the front page and people think it's clearly on the table, but I don't think it'll happen.
Yeah, of course, a signal coming out from Nick Timiraos in the last couple of days. But you make the point about a bureaucratic Fed, sort of the complexion of this Federal Reserve under Jerome Powell. How do you invest around a bureaucratic Fed?
Well, they're actually really easy to predict. So that they tend to be behind the curve. It's almost like that's their third mandate, is to be behind the curve. So that's why I think it's pretty easy to say they're not going to do the 50. They're going to talk about it, but not do it. And then you have to be very, very focused on the housing sector. We've had the right call for 4 years, which is we weren't going to have a recession, but then got nervous about it. So it's been pretty easy to predict. Like we said they would cut in July when everybody else is saying they'd cut right away because they're just cautious. Their models don't really work for forecasting. And so they should have cut in July. That's when the data made it obvious. So it's actually very easy to predict this Fed because they are bureaucrats.
Let's talk about the rest of the way through this year, because it's interesting. I understand you still have that price target of 6,000 on the S&P 500. As Katie's been pointing out, we've had a good week. It's Friday the 13th. You are not seeing the jitters really in the market today. Not yet. The day is young. But you have also said to us that this has a lot of uncertainty around who takes office in November. It's a lot around the presidential election and tax rates here. What's the delta?
Well, I think people tend to overestimate the importance of the presidency and the impact on the economy. Really, all that matters is tax policy. And tax policy only changes when there's a sweep. So if there were a Democratic sweep, we do see our target going from 6,000 to 5,400.
Wow.
Just
what
because,
are the chances of that, really?
Well, I'll tell you, if you take the betting markets and do cumulative probabilities, it's 8%. So in other words, you take the probability of Kamala winning, taking the House, which is 68%, taking the Senate, which is only 25, and you get 8. It's 12 for a Republican sweep. So the most likely case is gridlock, which is bullish for the markets. Usually there's less spending, less change. Change is disruptive.
Right.
Even tariffs are disruptive. Increases in corporate tax rates are terrible for not just earnings, but international competitiveness. So we're still really bullish on, and we believe in our 6,000 target, but we just want to note, usually people ask me what the risks are, and I'm like, well, there are no risks, which is that's why I'm not a popular guest. Well, but now there is a real risk, which is a sweep or upside, not just if the Republicans sweep, but if they also cut corporate taxes.
Well, that's where I wanted to go, and I'll just add, you're popular on this program, so rest easy.
Flattery gets you everywhere.
If there's a Democratic sweep, I mean, it's really shocking to hear how much your price target would be affected. If there's a Republican sweep, can you game plan that same analysis? What does 6,000 go to?
It would be about 6,700. And the thing that most people don't appreciate, it's not just the earnings impact. I mean, that's the most obvious, but also the growth impact. Because companies grow because of their retained earnings after tax. So if you tax them more, then you're going to have less growth and a less multiple. We're forecasting at 25%, which is what we're hearing out of Congress, by the way, as a compromise, not 28, because we do make small donations to even Democrats. So, but at 25, you just have a direct reduction in earnings. It's not like a political thing. Just they go down and then the stock prices go down.
You know, Jay, an investor yesterday made a great point to me about what the bond market is saying. And if you look at the number of rate cuts priced in, you have more than 100. I believe this morning you still have 117 basis points worth of rate cuts priced in. The investor had told me that don't think about this in terms of how investors think rates are going to be cut. Think about this in terms of a risk premium being priced into the market about what the government needs to pay you to own bonds. That perhaps there's a certain percentage here, maybe 25% chance here, that you could have a worse outcome in terms of a recession than currently being priced in. And you need to pay more because of where the fiscal situation is. How much of the bond market pricing right now is just element of probability here, this idea that you need to price in that risk?
Well, I think the key point there is that everybody just looks at the U.S., or not everybody, but most U.S. investors look at the U.S. because you can get away with it because we kind of dominate the world. But I would recommend the Bloomberg screen of the day is WB. So that's the world bond market. So you can see that premium for U.S. fiscal irresponsibility on how much more we pay than other countries. So Canada, which is not very far away, pays 70 basis points less than the U.S. because they're more fiscally responsible. So I think that's where you see the risk premium, is that the U.S. pays more than they really should because we run huge deficits that cause our rates to be above global rates.
All right, appreciate the Bloomberg Terminal shout out.
Right.
Usually it's Matt Miller who's calling out esoteric functions. So, Jay, this was great. Have to have you back on around the election. Really great insights. That, of course, is Jay Hatfield of Infrastructure Capital Management. Meanwhile, let's take a look under the hood. What's moving underneath these indexes right now? Here's Abigail Doolittle.
Well, one stock that's helping to drive the S&P 500's gain. Take a look at the shares of Uber. Actually, two stocks, Uber and Alphabet. Uber has announced today that they're expanding their partnership with Alphabet's Waymo autonomous vehicle unit. This is an exclusive deal to offer driverless rides in both Atlanta and Austin using those Waymo vehicles, driverless vehicles. And you can see Alphabet is higher as well, but Uber really getting a nice pop, up nearly 6%. Turning to United Airlines, these shares are higher as well. The company is announcing that they are going to be offering free Wi-Fi using SpaceX's Starlink. This is a win as well for SpaceX, of course, a private company, but this is the first major carrier to use Starlink, and investors seem to appreciate this news, up 1.7%. And then finally, we do, of course, have some laggards as well, one of them being Adobe. These shares are down dramatically, down about 9%, the worst day since March, after the creative software company essentially said that the outlook's not quite as good, as strong as had been expected. Some of their AI tools, the demand is weaker than anticipated.
Abigail, thank you so very much. Now coming up, the CEO of tire manufacturer Pirelli joins us next in the C-suite. We are going to make this a story about racing and the best tires to use for it. This is Bloomberg. And now to high interest, a look at what's making headlines around the world. Donald Trump's allies want to have a second bite at trying to privatize Fannie Mae and Freddie Mac. Talks among former Trump administration figures and bankers have been underway since at least this past spring, according to reporting by the Wall Street Journal. And if allowed, the government could raise over $100 billion in a sale of securities in one swoop. That would be the biggest stock and bond offering in history. And hedge fund Millennium Management is looking to raise between $7 and $10 billion of new capital. It will do so by asking clients to make pledges that Millennium can tap over time. Like its peers, the hedge fund has been moving to lock up client cash for longer. And Pink Floyd is in talks with Sony over a music rights sale. Talks are advancing after personal differences between David Gilmour and Roger Waters made reaching an agreement difficult. The band's iconic catalog, including Money and Dark Side of the Moon, is valued at about $500 million, Katie.
All right, switching gears here. Earlier this week, Pirelli and Bosch signed an agreement aimed at jointly creating new software-based solutions and driving functions. The vision is to give drivers greater control, comfort, sustainability, and improved driving dynamics. Let's get into the details now. I'm pleased to say Pirelli CEO Andrea Casaluci joins us now, and it's great to have you with us. When you think of Pirelli tires, you think about Formula One, of course, and maybe this is unfair, but when I think of Bosch, I think of course, high-end household appliances such as dishwashers. So maybe you could give us a little bit more detail on this marriage and how this works.
Yeah, thank you so much. So today, tires are very important parts of a vehicle, but responsible to transfer forces from the vehicle into the road. But tomorrow, what we want to do together with Bosch, thanks to this new joint development agreement, is to make tires able to talk with the car, collecting data thanks to the sensors that we are applying to tires, elaborating this data into useful information thanks to the algorithms we have developed, and then use this information to dialogue with the vehicle dynamic and improving the safety and the driving experience of our customers.
Andrea, it's interesting. Your tires are, of course, considered more high-end. They're used in very high-end racing cars. You think about F1 and the technology needed for the drivers to really communicate with their tires, for example. When you do things like this, as you've done with Bosch, how much more available does the technology become to a wider audience here?
Yeah. The target of this relationship and the development of this technology is to reach the wider market of at least the premium segment. As always, when we introduce new technology, we start from the motorsport and the prestige segment, as we did, for example, with this new technology, starting working with the hypercars of Pagani. And then once we consolidate the technology, thanks to these incredible open-air laboratories that are the motorsport or the prestige segment, then we try to move the technology into a larger scale and the wider premium segment. The target we have is to reach the wider market in the coming 2 years, because the technology we are working on with Bosch is already at a high level of maturity.
Well, excited to see, of course, this partnership bear fruit. I'd also love to get your perspective on the broader industry right now. Of course, Pirelli recently reported earnings, and you kept in place your targets for 2024. You beat on certain measures, but you also said that the market is expected to be flat year on year compared to around 1% growth forecast in May. So a downgrade of overall growth expectations for the broader industry. How do you plan to navigate through that? How are you going to stick to those financial targets that you laid out?
Yeah. Look, you're right. The market in the automotive, as far as car registration is concerned, is expected to slow down in the coming months, mainly due to a reduction on car registration in Europe, but also in North America and China, we see some slowdown in the demand. Nevertheless, inside this slowing down scenario, the high-value markets, which is the core of our business model and our strategy, is still keep on growing around 6%. So despite the slowdown of the wider automotive market, the high value is maintaining its speed of growth. 77% of our sales are concentrated in the high value, being Pirelli the global leader in prestige and premium segment as far as tire is concerned. And so we maintain the pace of growth of the high value. And thanks to the strategy we have and the target of growth we have mainly North America, we confirm our target within the end of the year, as we presented in our last analyst call.
I also want to talk a little bit about China. There's been a lot of concerns about Chinese demand in basically every market, most notably this week in the oil market. You've seen that plunge in oil prices. What about when it comes to tires? Because tire volume was down in July. How do you see the Chinese situation developing?
Yeah. Well, let me divide the China tire market in between the replacement market and the original equipment. Original equipment in the first half of the year was extremely positive, leveraging on the fast growth of the electric vehicles. Because as you most probably know, the Chinese market was able to increase the penetration of EV, and today that represents half of the car registration. And so the growth was positive. It's true that we have in front of us most probably some months of slowdown, also because of a less favorable comparison versus last year, but all in all, the trend of the car registration remains positive in China. While if we move into the replacement market, yes, in the last 2 months, we are facing a negative market, a negative 3-4%, and the expectation for the second half of the year is not to recover. And so there is a slowdown of the general consumption in the replacement channel. But again, the high-value market inside this environment is maintaining its growth and remains on around a single-digit, mid-single-digit growth. That's the expectation we have.
Andrea, we thank you so very much for your time. Of course, that is Andrea Casaluci, Pirelli's CEO. And still ahead, the cat's meow is no longer Clorox kitty litter. We're going to have the scoop in the social climbers next. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Uber announcing it will be the sole supplier of driverless rides with Waymo cars in Austin and Atlanta. This exclusive deal is a boost to Uber's ambitions in the autonomous vehicle arena. Next up, the online betting company Flutter announcing it will buy a 56% stake in the Brazilian gaming company NSX Group. This move allows Flutter to expand into the soon-to-be regulated market in Brazil. And finally, finicky felines are roiling the bottom line for Clorox. A hack last year halted production at U.S. factories and led to shortages of its popular line of Fresh Step litters. But now that supplies are back online, cats have moved on. Clorox, for its part, is embarking on a campaign to persuade pet owners to switch back. But in my experience, you can't really persuade a cat to do anything. So it'll be interesting to see how that one goes. Meanwhile, let's take a look at the markets right now because we're about an hour into the U.S. trading day. You take a look at the S&P 500. We do have a rally on our hands. If this holds, this would be a fifth straight day of gains. Currently up about 0.4%. But as we know, there's a lot of volatility in this market, and that is especially true for your big tech benchmark. Of course, the NASDAQ 100 rather up 0.4%. The S&P 500 currently up about 0.6%. Sonali.
You know, it's funny, Katie. I do think that cats over humans is the way to go. Clorox and General Mills here all focusing on pet lines and, of course, trying to win those customers back. Pretty fascinating story. Now, coming up, we're going to talk to Harvard economist Jason Furman, who says the case for a 50 basis point cut next week is not there. Stick with us for that conversation. This is Bloomberg.
Americans spend about 11% of their income on food. It's about the same numbers it was 10 years ago, but prices have gone up over that time frame. And there's some lurking price increases that are sort of interesting and think about how these things get caused. Things like in the last few years, we're paying about 50% more for tractors and trailers, the big rig trucks that get the products from the fields or from our DCs into our stores. The freezer cases in our storage are about 35%.
That was Tony Sarsam, the CEO of grocery retailer SpartanNash, speaking to us in the last hour on food inflation. And now, on the heels of inflation, all eyes are going to turn to next week's Fed meeting. And economists are split on how the Fed will communicate policy action. Certainly traders are. Here to weigh in is Jason Furman, Harvard economics professor and former chairman of the Council of Economic Advisors during the Obama administration. And I want to pull up kind of the dispersion in views here. Bill Dudley, of course, overnight saying there's a strong case for 50. We know that you believe otherwise. So why do you disagree? Is that fair to say?
Look, first of all, the most important thing is the Fed should clearly cut rates. Inflation is down, unemployment is up, rates should not be where they were a year ago. Second, the Fed should communicate that it is starting a process of rate cuts and it expects to do more of them at future meetings. The reason I think it's better to start with 25 is that they chose not to cut rates in July. The data since then has moved in multiple directions. Yes, the unemployment rate is up, but consumer spending is really strong. GDP came in really strong. And now you have the CPI a little bit above expectations. So they set out a reaction function. They said they were going to cut rates twice this year, back in June, basically, in their forecasts. You know, I don't think going all the way to something like 4 cuts this year, based on the data we've seen, is the right way to update their reaction function given the data.
Well, Jason, building on that, I'm curious what you make of the Fed's communication thus far, because there was a speech from Chris Waller last week, of course, which caught a lot of attention because he talked about the concept of front-loading cuts in the same way that they front-loaded hikes. Maybe they'll be more aggressive at the start when it comes to the cutting cycle. He did say if appropriate. There was equal emphasis placed on that, but why even open that door then and sort of invite the possibility of a jumbo cut?
Yeah, no, it's amazing. I mean, we have the Fed meeting coming up and the markets are basically 50-50 as to which of these two ways we're going to go. Now, part of that isn't quite as dramatic a difference as it sounds, because if you say, hey, we're doing more now so we can do less later, that's not massively different than we're getting started now and we're going to do more later. It's the cumulative amount that matters and the signal that they send. But yeah, this is a unusually high amount of suspense for a Fed meeting.
What would 50 basis points say if they cut that much in the first meeting? It's interesting to think about this idea of tone setting, because can't they just, if they did that 50 basis points, can't they just sit there in the conference and then say, don't expect this over and over again? I mean, don't they have tools at this point to kind of set better expectations in the market? Why leave everybody waiting so badly?
Look, there's another way to conduct monetary policy, a totally different paradigm where at every point in time, you just have rates where they should be. And then at the next meeting, you're just as likely to raise them or lower them. That's just not the paradigm that this Fed has had. For some time now, it's had a gradualist approach. It's had a repeat things meeting after meeting approach. And to completely change the way people understand and forecast what the Fed is going to do in the future, I think would be quite hard right now. So they have to say, this is how we operate. We're operating this gradualist paradigm. And we didn't move in July. The data since July justifies one cut. It doesn't justify something very different than what we were planning back in July, given how really robust demand is in our economy.
And Jason, it's interesting in hearing your pushback to the idea that they should go 50. I haven't heard you bring up inflation and the fear of inflation reigniting, because usually people say something along those lines, that we're not sure that inflation is totally licked yet. I think that you talk about inflation rate now. I mean, how confident are you that it's in the rearview mirror?
Look, there are definitely risks on both sides of the mandate. There remains an inflation risk. I think underlying inflation now is probably running at about 2.5%. I think there is more downward pressure than upward pressure, given how loose labor markets are. But there's a lot of uncertainty in that. A lot of the low inflation we've had has been falling prices in just a few goods like autos and used cars. I don't think that will continue forever. We're not getting the shelter disinflation, and we may not, that everyone was hoping to get. And wage growth that we're seeing is consistent more with 3 to 3.5% inflation. So I can tell a lot of stories about inflation going up from 2.5 rather than down. That's not my best guess, but that's a real risk, and that's part of what the Fed is insuring against by approaching this pivot that they're now embarking on cautiously.
Jason, I understand that the Federal Reserve has to work with the reality that we live in right now, but right after this meeting and before the next meeting, you have a presidential election, don't we? And so we're sitting here in a scenario in which you have politics here that could reignite the inflationary story. You said on Twitter at the end of August that one of the policies that you actually liked being thrown out by the Biden-Harris proposals here is to tax unrealized capital gains. I want to pull up this tweet here. I also want to point out that in this set of proposals being thrown out, you haven't agreed with everything. Because you've been affiliated here with the Obama administration and a Democratic administration, I want to point out that you have not been aligned with everything that has been thrown out there. But this unrealized taxation of capital gains here has been extraordinarily controversial for this market. Can you explain why you think this is a good idea?
Yeah, so first of all, I speak my mind whenever I can. And there's a lot of tax nerds that for a long time, both Democratic and Republican inclined tax nerds, that have actually liked taxing unrealized gains. There's a bunch of ways in theory it's good. In practice, it's incredibly tricky. I don't think you can do it at a very high rate. I was really glad to see her pragmatically backing off the 40-something% capital gains rate that was in the Biden budget. I think that's good economics of her to go lower. But I was making a sort of bit of a tax nerd point. Frankly, this debate is all academic. I don't think I should be using academic as an insult. It's not something Congress is going to do. And so maybe we should keep talking about it more in seminars than elsewhere. But the bigger thing is, if she's elected, there will be a difference in terms of taxes on the rich and corporations than if Donald Trump is elected. That's a genuine difference,
Well,
but I don't
Jason,
think this is the form that difference will take.
Increasingly, this tax question is becoming a bigger and bigger concern to the market. To your point that you're making, it would be billionaires and corporations. You've also made the point that perhaps more even taxation across the board would be better. And so how do you think things end up at the end of the day, especially if you are kind of looking at the composition of Congress that won't allow perhaps some of these Harris policies to come through the tape if she's elected?
Look, I would be thrilled out of my mind if when the tax cuts expire next year, it became an impetus for tax reform. and people could just think in a more sensible way about how to do the whole thing. For example, on the business side, making expensing permanent. That's a great incentive for business investment, tightening up some interest disallowances to help pay for that. So, on the individual side, we could broaden the base more in order to pay to keep some of the lower passed in the law that weren't paid for the first time around. So I'd be thrilled with tax reform. I'll certainly be out there trying to do what I can to advocate for it. The political system, though, may find it easier to just extend some things, not extend others, and have an argument over that fixed universe.
Right, of course. We'll have to see if tax reform is feasible, no matter who takes the White House in November. I do want to transition into a conversation on price gouging, though, of course. There's been many conversations of that. We were just talking to Tony Sarsam about that in the last hour, about whether he sees evidence of price gouging. He says no. Maybe you can help us be specific here. Price gouging is getting thrown around a lot as a phrase, but when you think about price gouging versus companies just raising prices, of course, to deal with higher input costs, what balance are you seeing there?
Yeah, so first of all, there's a question of, is price gouging an important thing that's going on right now and we could lower grocery prices by tackling it? Absolutely not. I mean, that's just a far-fetched notion. There's still quite a lot of competition in these sectors, and prices move up based on supply and demand, and you try to get in the way of that, you cause some really, really bad side effects. There is then a second question, which is, in very extreme natural disasters or emergencies, are there temporary surges in prices the government should do something about? I am quite skeptical about that too. I think we can identify that. It stops the things from moving into the disaster areas. But a lot of states do that. There are some economists that support that. So I don't think that second version is completely crazy. I think it's unnecessary, though, at the federal level, and not something worth doing.
All right, Jason, have to leave it there. Fantastic to get your perspective. Have a great weekend. That is, of course, Jason Furman. Meanwhile, about an hour into the U.S. trading day on this Friday, the 13th, let's get a check on these markets with Bloomberg's Abigail Doolittle.
Well, it seems it may be a lucky day for stocks. So we have the S&P 500 up for a fifth day in a row. In fact, for the S&P 500 right now, over this time period, up 4%. This is the best week for the S&P 500 since November of 2023. So last week, of course, a brutal sell-off, the worst week since 2022. But those dip buyers, they are really out in force, especially as it pertains to big tech. One of the reasons that we have the S&P 500 and the NASDAQ nicely higher on the week has to do with some of the chip makers on the week, including Broadcom, Supermicro Computer, and NVIDIA. You can see these shares all nicely higher. One of the best weeks for these stocks over the last many weeks. So we're seeing a rebound in some of these AI-related chip names. And then take a look at Oracle here, up 16.1%, potentially still the best week since 2002's at the highs on the week, the best week going back to 2001. That's the degree of the buying power on a great quarter, a good outlook that was provided most recently in an investor update. That quarter, of course, earlier this week, and a new partnership announced with AWS. So the AI demand for Oracle strong. Perhaps that's what's helping these AI chip stocks climb as well. And then, of course, there's the topic that you were just debating in quite some detail. Let's put it together with a Bloomberg terminal chart, because as we do have the debate around how much will the Fed be cutting this month, you can see just yesterday it was closer to just one cut, 25 basis points. But right now we've come off of that lower level. So right now it's still closer to that 25 basis points, but it's not exactly there. So this debate sparked off by policymakers per a Wall Street Journal report debating the scale of the cut really has us between the 25 basis cut and the 50 basis cut. Right now, with the stocks up so much on the week, it seems as though investors are enjoying that debate.
Bloomberg's Abigail Doolittle, we thank you so very much. Now, coming up, one step closer to the presidential election. Blair Efron of Centerview Partners tells us how Wall Street perceives the debate between Vice President Harris and former President Trump. This is Bloomberg.
It's time now for Wall Street Week, and Vice President Harris and former President Trump went head-to-head on their policies this week. Wall Street Week's David Weston asked Centerview Partners co-founder Blair Efron why Wall Street should support Kamala Harris.
The markets have done better under Democratic presidencies over the past 50 years than Republican presidencies. The third year of the Biden administration, which means no COVID impact, versus the third year of the Trump administration, which means no COVID impact, higher GDP, more jobs, better market performance. The CEO, he or she wants stability, wants a free market-based economy, does not want to be sitting here with 10 and 20% tariffs across the board, which is upwards of 1% hit to GDP, 700,000 jobs. They want support from the public sector in a way that helps their business. If they know with certainty what the environment's going to look like, it helps them. And I also do think the signaling matters. When the VP talks about business, she talks about small business, which has been a big focus of hers for a long time. She talks about the entrepreneurial business, the startup community, and she talks about big business, that we're all in here together, aligned to figure out how to grow the economy for broad-based growth, again, back to the middle class. And I think most CEOs understand that.
Let's go to the other side, that is the Donald Trump. I'm not going to ask you to defend his position, but in fairness,
that would be hard.
Well, but in fairness to him, he says one of the ways he's going to address that deficit and that debt is with tariffs. And put aside the fact that that really comes from consumers and is in fact a form of taxation. Why is that not a way to actually retire some debt and deficit? Now, it is a tax. You know, he doesn't call it a tax, but it is on the U.S. consumer. But it is a way of retiring debt and deficit. Why is that wrong?
Because quite simply, if you have tariffs, you're hitting GDP. His 10% hits GDP, perhaps, as several economists said, 1% hit. If he does 20, because he's been saying between 10 and 20, it's a 2% hit. At 1%, jobs, $750,000 jobs at risk. At 2%, 1.5 million jobs. That obviously has a big hampering effect on the economy. In addition, the tax to consumer is real. And if you think about 20%, he's almost at $1 trillion of tax to consumer. That does not go, David, to defending the deficit. The deficit needs money coming into the system. That's the deficit. It's not money hurting the pocket of the consumer.
We tend to focus on the presidential candidates at this time in an election cycle. There are two houses of Congress also, whose majority will be determined. Right. What either candidate can accomplish will be determined by what happens in the Congress. How important is it that the Congress go one way or the other? Well,
you do know, obviously, the presidency has a lot of authority through executive power. But clearly, depending on how Congress goes, is always important. And right now, you can see the House going Democrat and the Senate more up for grabs. But we will see. But I also think as part of this, David, it's the signaling that a president gives that gives the markets, that gives business a confidence, okay? And the signaling about how you think about deficits, the signaling about how you think about growth. All of this will matter, and it's not just the matter of the policies, which one get through. It's a matter of how you discuss what you want to do. And by the way, when you talk about regulation, the vice president has been very clear. She wants to see, in certain areas, reform that regulatory is less expensive and done more quickly, particularly around the housing market when we want to get 3 million new homes.
So I'm glad you raised regulation because former President Trump has been very explicit. I think it's 10-1 now. He's saying we're going to eliminate 10 for every new regulation we have. What is the proposal to reform on the other side? Because part of the argument for some people is what we need for that GDP growth actually is less regulation.
So again, a little bit of a myth. There was as much regulation under President Trump as there was under President Biden. Done in different areas, but that's part of what goes on in the government right now.
And that was Blair Efron of Centerview Partners speaking with David Weston. That conversation and more on Wall Street Week tonight at 6 p.m. New York time. This is Bloomberg. All right, let's go over to ETF land, where wild swings in the markets are being blamed on leveraged ETFs, which, as we know, have become very popular among retail investors in recent years. And you have JP Morgan and Nomura saying that the ETFs they're having a real influence on the broader markets and all of the volatility that we're seeing. Let's unpack that argument, of course, with Bloomberg's Denitsa Seikova. So give us both sides here. What are JP Morgan and Nomura saying? And is anyone sticking up for these leveraged ETFs?
Well, we have to start with the AUM. If you look at the AUM, they're at 120 billion. Just 4 years ago, this was 40 billion. So massive exposure of AUM that's very heavily concentrated into tech stocks, and they're having especially heavy influence on them. So what we're seeing is due to the mechanics of them, and they target like 3 times leverage, they have to rebalance in the last 30 minutes of the day. And often this happens just in the span of 10 minutes. So we're talking around 15 billion of balancing, which, you know, in a 600 billion a day stock market is not that big. But in a span of 10 minutes, actually, it's exerting a lot of influence. And we're seeing Morgan Stanley, we're seeing Nomura, we're seeing JP Morgan, all of them saying that during those 10 minutes, it's actually having a really big impact, especially when liquidity is a little bit dicey and the moves are really big.
I loved what you cited here from Morgan Stanley's quant team here, that actually that leverage ETFs may be exerting their biggest ever influence on the broader marketplace. Specifically, for every 1% drop in share prices, these funds would need to sell almost $7 billion of equities. How hard is it for them to do that?
Exactly. That number is really growing. The universe is a record AUM, and you can imagine if we see like a 2% move in the S&P, that means 14, 15 billions, which is something we have seen a lot lately. Of course, a lot of people are saying there are many other forces, there are zero-date options, there are so many technical rebalancing that are happening at the end of the day that, of course, are also a force. But at the same time, we see a lot of the big Wall Street banks writing about it. And we see a lot of people saying that they take it into account when they consider their end-of-the-day moves.
Right.
And especially, they're very focused on semiconductors, on NVIDIA, on all those big names. And everyone is watching them.
Yeah, and I mean, you make a good point that there's plenty of different culprits to point a finger at here. But I mean, part of the reason why we have these in focus is because they're just so big. And unfortunately for the people who are worried about these, they're just getting bigger.
They're getting bigger and bigger. We saw record launches this year, 46, which is almost double what we saw last year. And an interesting trend is we see people competing to get more and more leverage. So the rebalancing gets more and gets bigger and bigger, the products get more volatile, and we see all those rebalancing being centered towards the most volatile and biggest names in the market. So it's definitely a force that we should continue watching and that everyone on Wall Street is talking about.
Yeah, of course, it's fascinating. You have 3 times leveraged out there, both long and inverse. It'll be fascinating to watch this space. Of course, Denitsa Seikova covering it closely. And remember to tune in to ETF IQ every Monday at 12 p.m. Eastern. I'm actually off next week, Sonali, so you'll be in the hot seat.
Hold down the fort for you.
Yeah, well, let's get a check on these markets right now. Of course, on this Friday the 13th, it looks like we may have 5 straight days of gains. Of course, it's been a little bit since we've seen that, given that rough start to September. But currently the S&P 500, it's on this side, actually. It's up 0.5% right now, of course, following 4 straight days of losses to start off this month. And Sonali, you think about what are the forces from here. You remember we have that big Fed meeting next week.
You could have the best week of the year if we hold these gains out. We're at a 4% gain for the week, 25 basis points until you would erase last week's losses. But yes, not so scary of a Friday the 13th. Now, coming up next week on Open Interest, we have some great guests for you for Fed Week. Kate Moore, BlackRock, Steve Eisman of Neuberger Berman, the CEO of KPMG. This is Bloomberg.